Welcome to Barchart's weekly series of webinars designed to help you, the trader or investor, understand a variety of trading ideas and concepts, as well as the pages and tools Barchart provides to help you to make a more informed investment decision. Today's subject, counter-trend trading, or profiting from price extremes. Now, counter-trend trading is a dangerous, risky style of trading that requires patience, discipline, and strict risk management rules to keep our trader from being run over by a freight train trend or being stabbed trying to catch the falling knife of price. Hello, everyone. My name is John Rowland, Barchart's head of trading and education, and today we're going to look at identifying these opportunities to trade against the trend, what tools we can employ to discover these opportunities, and ways to reduce our risk, increase our probability of success by setting realistic and achievable targets before our primary trend returns. Joining us today is my partner and our moderator, Barchart's project director, Jean Baker. Hello, Jean.
Hi, John. How are you?
How are you doing today?
Good. Getting back into the swing of things from that holiday week.
Yeah.
How about you?
Myself,
Same?
Yep.
Yeah.
I can't believe it's December already. It's amazing, isn't it?
Yes, time flies.
Time certainly does fly.
Yeah.
Okay, ready to get started?
Yeah, when you are. Let's go.
Let's go. All right. This webinar is for educational purposes only and should not be interpreted as a recommendation to buy or sell any security. Counter-trend trading is inherently risky and is not suitable for everyone. Decisions to buy, sell, or hold or trade in a security, commodity, or other investments involves risk and are best made with the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages you or anyone incurs as a result of trading or investment activity that you or anyone else engages in based on the information or material you receive through barchart.com or our services. Okay, got that out of the way. So let's get started. Here we go. All right, so what I've done here is I opened up a chart. This is a chart of Tesla. Now, moving averages are one of the oldest and most reliable technical tools used to identify trend. Moving averages smooth out price data, creating this trend following indicator. An uptrend price fluctuates above the moving average. It's lagging. The moving average is lagging. Statisticians will call this the mean. Now, occasionally, price deviates far from the average. And when this occurs, this is creating an opportunity to trade as price returns, keyword, returns to the average, something called mean reversion. So this is going to be the basis of our discussion today, discovering price extremes. Now, though there are many technical analysis tools that could signal price extremes, and some of the examples that come to mind are RSIs or MACDs or stochastics, we're going to concentrate on the concept of mean reversion. And because of three factors. One, we'll be able to determine our risk. Two, using confirmation of price reversals. And three, choosing realistic targets and reward ratios. Now, it's easy for the eye to recognize where price changes direction dramatically. And these dramatic reversals tend to happen where price retests a former area where price failed to continue a trend at hand and accelerated away in the opposite direction. So this is copper. And let's just go from left to right. So you can see here we got a nice little trend starting. We got a couple of nice accelerating candles where this trend really starts to pick up momentum, and price moves away. Then price fails to get higher, right? The trend stops, and then price starts to fall away. So we fall away on an accelerating candle here, and then it falls again. And then the third time, a big price acceleration. Now price falls until it finds that area where price had accelerated away from the previous trend. Then it holds it again, and then price moves up until it reaches an area and fails or retests an area where price failed to go up and went down. It retests that zone. Then price falls away, accelerates, and retests, in this case, the origin of this last big uptrend. But this is also the spot where price failed to continue to go down and started to go up. And again, you can see here, price is accelerating and it retests an area where price failed to continue away or reversed in price direction. So what do we say? Moving average. Let me add a moving average. And I'm just going to use a simple 20-period moving average. This is a daily chart, so we're looking at a 20-day moving average. And if I added the blue line here that represents that 20-day moving average, notice now that these reversals seem to coincide where our price deviates far from our mean, far from our average. Look how far price had moved from our moving average before it found that zone. Now, this is the first part of our process, is identifying these large price movements, these deviations, where price is allowed to run path of least resistance, and then where the area or zone of support or resistance where price previously moved away or where price changed direction and where it failed to continue the direction of the previous trend. So price reversal. So it's really easy for our eye to see this, and this is going to be part of our process. We're going to look for the areas of supply and demand, or these support and resistance zones, and then when price deviates far from our mean, then there's going to be a higher probability that price is going to change. But some of us might be difficult for us to do this process. So there is a study we can use that's going to help us enhance these zones or help us identify these opportunities. And that's called Bollinger Bands. Now, the math behind Bollinger Bands is it's a statistical probability based on standard deviations. And a Bollinger Band is going to create 3 lines. The middle line is going to be our moving average or our mean. And notice that the default setting for Bollinger Bands is 20 periods. So if I'm looking at a daily chart, then I'm seeing a 20-day moving average. The upper and lower bands or lines are going to be based on something called standard deviation. And the default for Bollinger Bands is 2 standard deviations. So remember statistics class? Think of a bell curve, a distribution of, let's say, price activity. Well, 1 standard deviation, 68.3% of price will fall inside of that 1 standard deviation. In other words, 2 out of every 3 days, price will remain inside of 1 standard deviation. 2 standard deviations, 95.4% of price activity will remain inside of 2 standard deviations. And that means that less than 5% of the time, price will be outside of 2 standard deviations. In other words, once every 20 days if I'm looking at a daily chart. A low probability occurrence, but a high probability opportunity, because once price reverts inside of 2 standard deviations, the Bollinger Bands, there's a greater probability that price will return to the average, mean reversion. That's the basis of why we're going to look at Bollinger Bands. All right, so let me add our Bollinger Bands. And here we can see Bollinger Bands are going to help us discover these deviations. Notice that our price action is outside of our Bollinger Band. A very rare occurrence, but a high probability that price is going to return back to the mean. So there's 2 processes here. First, we're going to identify the zones that we think where price is going to change direction, and then we're going to look for those zones that are outside of our Bollinger Bands. Now, there is another study that we can use that's similar to Bollinger Bands. So let me remove Bollinger Bands. And that one is Keltner Bands. Now, the main difference is they're relatively the same. They're going to have a mean, in this case, 20-day period or 20 periods, an upper and lower line, upper and lower band. But Keltner Bands are not on standard deviation. They are based on an average true range, a multiple. And in this case, the default is 2.5 times the average true range. If I add those, again, you can see that many of the same zones that we discovered with Bollinger Bands, where we see price reversals, are the same with our Keltner Bands. So what's the difference, right? You can use either one. These bands tend to be a little bit wider, right? Because they're a little bit more sensitive to current price. It's an exponential moving average, and also we're using the average true range to form our outer bands. If I re-add my Bollinger Bands, notice that in the purple line is our Keltner, and our green line here is our Bollinger Bands. So we can use these to both enhance and confirm an area where we believe price is going to reverse. Now, what's kind of nice about this, the way I use it, is I like to find when my candles are outside my Bollinger Band, but are right on the other band, the other side of the band, and that they're inside of this envelope, again, between the 2 different studies. So here again, you can see these 2 candles are in this little envelope. And these usually are really good setups that are going to have a good result in terms of our mean reversion. So we can use those in concert with each other. So let me get rid of those for a second. We'll go back to our Bollinger Bands. All right, so we've already done some of the work, right? We've identified our zones of support and resistance. Now what we need to look at is price confirmation. In other words, we're going to look at a change in the color of our candles, green to red or red to green. 2, we want to see price return inside of our outer band. Ideally, we want to find a whole body candle outside of our outer band. And we're not going to consider or concentrate on these smaller piercings of our outer bands. We really kind of want to find that whole candle outside. And we will find more favorable results after our bandwidth widens and not when our bandwidth is narrow. So let's walk through this process. Okay, so we have two candles that are outside the Bollinger Band, right? Notice that price is moving down and it is piercing outside the band, but yet this is the first two candles that are totally outside the band. Also, our band width is narrow as we first start to see our piercings happen. Here we can see our band width is much wider. Again, here we see price is accelerating out. We see a couple candles that are pushing outside the Bollinger Bands, but here's the whole candle that is outside of the band, and our bandwidth has widened, right? Here we see price is starting to move out, right? We see a couple candles that are bouncing outside, but our bandwidth is very narrow. We want to wait for it to widen. Here's a great example of that, right? Price, 3 candles are piercing outside of the Bollinger Band, right? Path of least resistance, the market is accelerating, it's really deviating away from the mean, but we still need to wait for that area to retest, and there is a very small body, doji-like candle that is outside of our Bollinger Band. And the width of our bands is very wide. So we're going to look for a change in color, red to green, green to red. We're going to look for those candles outside of our Bollinger Bands. And we want to see price return inside of our band. Think of like a rubber band. Here we're seeing the pressure is stretching the band, and then once the price pressure is released, the rubber band is going to snap back. So we want to see price returning inside of our Bollinger Bands. And we're going to find greater results with wider bands than narrow bands. All right, so that's going to take us to step number 3. We're going to look at reversal patterns. How can we define that price is going to change direction? So in our site education page, you can find that under the tools section. If I scroll down to the bottom of the site education page, there is a file here. It says identifying candlestick patterns. Now this was attached to a webinar that we did a few months ago based on I think the name of it was Understanding Candlestick Patterns. You can find that in the archive section under the tools of our webinars. And if you open that file up, it looks like this. And inside there, you can find 17 different types of reversal patterns. Now, candlestick patterns alone are very subjective, but when we combine them with Western methods of analysis, in other words, in this case, we're going to be looking at trends and support and resistance, right? Their ability to reveal price reversals is highly effective. And the key is waiting for the candles to close before confirming one of these reversal patterns. So herein lies the patience aspect of counter-trend trading. We still need to wait for a confirmation. We can find these zones, we can find these extreme price movements, but we still need to wait for a price confirmation. So there's a lot of ones that we have here, and not just a few of the ones that I'm fond of. I do like these bullish and bearish engulfing patterns. I think those ones are really nice, very common in these Bollinger Band scenarios. Dark clouds, haramis, and then our stars. You'll see a lot of stars for sure. Morning stars, evening stars, shooting stars. All right. So let's just go to bearish engulfing. And again, now imagine here's our price extreme. Price is shooting up. And maybe this is our one candle that is outside of our Bollinger Band. And then we get an engulfing candle, a green to red, where we engulf this green candle. Now, on all of these formations that I have put up here for you, I do show you where you can recommend where we're going to set our stop, where I'm going to set my stop loss, and we'll talk about that in a little bit, and where I want to see price confirm that this candle is engulfing, or where I could look for a potential entry based on this reversal pattern. And there's a really nice picture here. You can see a nice trend up, and there is our engulfing candle. And once price got below this green candle, that would have been a confirmation, and that would have been an opportunity for us to take a short in this particular scenario. Hangmans are kind of like a star formation, very common. There's a nice hangman right there. Again, imagine if I was looking at a Bollinger Band, this could be the whole candle that is outside of our Bollinger Band. Dark clouds, another one that is very common. And haramis. You'll see a lot of haramis where you see a reversal in price action that is inside of the range of the candle that went outside of our Bollinger Bands. And if I can find a harami that is outside of the Bollinger Band and then get that confirmation as price returns inside the Bollinger Band, that's going to be a nice setup. And then our stars, our morning star, our evening stars, and our shooting star. So I'll leave it to you to look at these examples. Okay. So, snap. Oh, snap. Let's reboot that up. All right. So I'm in the E-mini S&P, and let me pop this out. This is a hourly chart, and we're looking at hourly candles. Let me move this over a little bit, and I'm going to make this a little bit wider for you to see. Okay. And again, what we want to start looking for is, that explosion of price that goes outside of our Bollinger Band, our whole candle outside, and that reversal pattern. And here we can see a shooting star. Then price returns inside of our mean. Now, this one is an unusual formation. This is not one of the more common candlestick formations. Sometimes you'll hear it's called twins or pinchers. And what makes this one unique is that when we look at the two candles, the closing price of candle number 1, this red candle, is the opening price of candle number 2. That's what makes this one unique. And you will see these a lot in the scenarios that we're looking for. So it could be red to green on the downside, or it could be green to red on the upside. The key is that the close of the first candle price is the opening of the second candle. It doesn't matter what the size of their shadows or wicks are. Ideally, we would like to see, in this case, the down candle have the longer wick and the shorter candle, the green candle, have the shorter wick, and vice versa if we were looking to the upside. But it doesn't necessarily have to be that. The key is the closing and opening prices. And then here's another one. This is kind of a shooting star as well. But notice this is a green candle. And again, we would need to wait for that opposite color, that red candle, to take that trade, right? So that's going to bring us to our step 4 and 5, which kind of go in hand together. And that is, we're going to set our stops, how we're going to set our stops, and how we're going to go about choosing targets. So first, let's talk about how we're going to set stops. So in that file, in that candlestick file, I show you a lot of areas where you can set your stop based on the structure, based on the candlestick reversal pattern that we're talking about. So we always want to pick the highest point in a sell opportunity of the candles that are creating our structure and candles that are creating our reversal pattern. Now, it could be the candle that comes into our area, or it could be the candle that comes out of our area. Whatever is the highest in the selling opportunities. And when I look at buying opportunities, which is ever the lowest, right? So that would be where we're going to set our stop. Our entry will be based on our confirmation, and then that will define our risk. The next part of our process is we're going to look at where we're going to set our target to do this assessment of, will I allow myself to take this trade? Now, the easiest target for us to do this assessment is the mean reversion. That's basics of the Bollinger Band. So what I want to do now is I want to look at how much risk I'm going to take on versus the reward that this trade potentially could create for me. So in this look at this example here, we have a stop loss based at 47.40.50. In other words, if price gets above there and my trend is back in control, I am wrong. I'm going to get out of this trade. My confirmation entry would be at 47.31.50. So in this case, the risk of this zone or the risk of this structure would be about 9 S&P points. My mean reversion, you can see all the way to the right, you can see is around 47.08, 47.08 and a half. So I'm risking 9 to make 23. 47.31.50 minus 47.08 would be 23. That is less than 3 to 1. That's about 2.5 to 1. Now, if I was taking a trade with a trend, I probably would take that trade, but we're taking a countertrend trade, and we need to get a greater reward for the risk that we're taking on, the risk that we're going against this trend. And 3 to 1 should not be our threshold. We should think about a higher threshold, maybe something like 5 to 1. Now, think about this for a second. If I set a trade up where I have potential to make 5 to 1, it's a lot easier to ring the register at 3 to 1. If I set up a trade where I'm only getting 2.5 to 1, well, it's a lot more difficult, especially if I'm fighting trend, to get 5 to 1. So we want to look for greater risk reward ratios when we take these trades. Every trader is going to be different. Every trader is going to have different goals. Every trader is going to have a different risk tolerance. For those of you who are starting to try this as a trading opportunity, start at 5 to 1. I think you'll find that you'll keep yourself out of trouble and your risks will be a lot smaller compared to your rewards. So let's go back to this one, this shooting star. This example here, again, let's look at our risk in this trade. Well, it looks like we're risking about 5.5 points. And what is my mean reversion? Well, my mean reversion is down here around 46.80. So I'm risking about 5 points to make, in this case, looks about like 26 points, or 26.25. 5 to 1, right? That is a better risk reward ratio. This would be a better trading opportunity, countertrend trading opportunity. I see a question here. George asks, I can't imagine a 9-point stop on a E-mini. Yeah, George, it depends on the trader, right? It just really depends. But some traders, 9 points in a market that moves 50 to 60 points a day, that wouldn't be a lot. All right, so again, looking at risk to reward, we're going to establish our risk first, look at our mean reversion as our reward, and decide if this trade is worth taking. All right, so let me go to soybeans here. And let's see if we can kind of put this all together. First, let me give you a little bit of a reference here. So we see soybeans here. This is a daily chart over the last 6 months, and you can see we are in this downtrend. I do want to point out, we're going to concentrate on this over here, but I want to point out before we go there, here you can see a big deviation from the mean, a big price, extreme price movement, and that price stopped at this little teeny zone here. So don't think that you have to find a big zone. You can find little zones. But what did price do? It stopped going down, and this was the origin of this nice uptrend move. So that's where we would anticipate that price would probably stop at least or react to that probable zone. And then you can see price did revert back to the mean. But I'm going to look at this over here. And why I'm here, I want to point out over here to the left, this is why I like this trade, because of this potential demand zone, this potential area of support. The origin of this uptrend and where price stopped going down and went up. Not only did it go up, but it accelerated away. So this is going to be a very good zone in terms of what I want to look for. And my zone is outside right now at this time right here, outside of my Bollinger Bands. The other thing I wanted to point out is that path of least resistance. Notice that this red candle that pushed outside of our Bollinger Band is right at where we broke through this little area of support. Okay. All right. So what did we say? I want to see an extreme price movement. Do I see that? Yeah. Do I see a whole candle outside of my Bollinger Bands? Yeah. Did price fall into an area where I believe that price is going to change direction? Yes. What is my risk? Well, in this case, I'm going to look for that reversal pattern, right? That reversal pattern. Remember, we said we like to see price return inside of our Bollinger Band. So in this case, not only do we have a reversal candlestick pattern, but that confirmation entry when price of this green candle breaks above this red candle is also where price now is back inside of our Bollinger Band. What's our risk? Well, our risk would be the lowest candles of the candles that created our reversal pattern, that candle there. So now what we're going to do, we're going to decipher our risk and to see if the reward is worth it. So you can see my entry would be around over here on the right. My entry would be around 1209.6. My stop is 1195.6. So I'm risking about 14 cents in soybeans. So we said we want to try to shoot for 5 to 1. Well, 14 times 5 to 1 would be 60. Now, right? Did I do the math right? No, 70. No, 60. Yeah, 70, excuse me, 70. Some days, Gene, right? The math just doesn't work in the head.
Yeah, some days.
Anyhow, where is my mean reversion? Right there. And that would be 1264. So we're only getting a reward here of about 55 cents, not that 5 to 1 that we want. So I could walk away from this trade, but I really like this trade. Why do I like this trade? Because of the zone that price is now coming into, because of this is an extended downtrend. So what can I do? Well, at this point now is I can drop down to a lower time frame using multiple time frames to help me find areas where I can maybe mitigate some of my risk. So let me go back to our lower time frame, and now I'm at an hourly time frame. And let me make this nice and wide for you, and let's move it up a little bit so we can see it. Okay. And just again for reference, when we went from the higher time frame down to the lower time frame, here is our stop level based on that red candle that was outside of our Bollinger Band. This line here represents where price returned inside of the Bollinger Band at the daily level. And then what we're seeing here, again, remember we're looking at different Bollinger Bands here. We're looking at a 60-minute time frame Bollinger Bands, but we are seeing our price action outside of our Bollinger Bands. Is this a reversal pattern? Well, I think It is, isn't it, right? This, in candlesticks, this is actually two haramis right next to it. So this is actually a very powerful reversal pattern. But even if I'm not a astute candlestick pattern trader, and I just trade patterns that I recognize from regular technical analysis, that certainly does look like a wedge and a breakout. So what did we say? We want to wait for price to confirm for us. We want price to get back above this line, this inside of our Bollinger Band. And here is where I've confirmed that price has reversed at a lower time frame. So I could set a stop down here. If price got back below this zone, that would be telling me that I would want to get out of this trade. So if I did that, notice now my entry would be 12.096. My stop would be 12.03 based on the structure that created the reversal pattern. And here I'm only risking about 6 cents or 6.5 cents, where my target was about 50 cents away, 55 cents away. So I'm risking 6 cents to make 55 cents, 9-to-1, much better, a much better risk reward ratio. So this is a technique where we can use lower time frames to look for the same kind of structures, reversal patterns that are familiar to us with our candlestick patterns, to allow us to mitigate some of that risk in order to allow us to take that trade. Now, some of you would say, well, John, look, the price popped above this entry several times before it actually shot away, and you might have just gotten stopped out. Again, you're correct, but let's look at the time of day that a lot of these candles were being created, 2, 3, 4 o'clock in the morning. I'm going to be more concerned about price action when the soybean market is more active, and that would be during its regular trading hours, about 7 o'clock in the morning to about noon in the afternoon. And notice that this big price breakout right here on this green candle, even if I used a confirmation once it got above these zones, 12.5, and used the lowest of the structure that was created in the morning session down here, 12.03, again, I'm risking 9 cents to make about 45 cents. So again, a better risk reward ratio. All right. So there's another technique that we can use that's a little bit more aggressive for more aggressive traders, those who don't want to wait or don't want to wait for those confirmations. So remember this box here, this golden box that represented our demand zone, our area of support. So one of the techniques that we can do is we can look for a penetrating entry into our zone where I can take risk on and get that good risk reward ratio. But in this case, we're not waiting for structure to be created. We're going to use the previous structure. In other words, I'm going to set my stop below my demand zone or above my supply zone, my area of resistance, or below my area of support. And what I'm going to look for is a penetration into this zone, a deep penetration. So what I've done now is I've gone into my drawing tools and I've pulled up the Fibonacci tool. And what I've done here is I've created a Fibonacci grid, and I want to look for a deep penetration. I don't want to look at this 23 or maybe even this 38. I want to look at maybe halfway in, or the 61%, or maybe even that 3/4 of the way deep into that zone. Remember, wherever I set that entry based on how deep it goes in the zone also lowers my risk. But in the case of this trade here, if I use the 50% retracement into the zone, my entry would have been around 11.96. My stop would have been, if price went through my zone, right, that would be 11.86. So I'm risking 10 cents on this particular trade. But what was my mean reversion? Well, it was 12.64. So now I'm risking 10 cents to make 70 cents, 7-to-1. That would be a nice return, risk reward return. Now, what I can do at this point is, if I get an entry and price comes to my target inside of my zone, and then price confirms, goes back inside of my Bollinger Bands. At that point, what I can do is I can raise my stop from down here, from a stop loss to my entry point, to just below the candle that entered me into the market. Now, what's my risk? Well, in theory, my risk is zero. Risking zero to make 70 cents. That's a good risk-reward ratio in anybody's book. But as the market starts to move away, I can also use opportunities to move my stop to make sure that I at least lock in some profits. So that's another technique that we can use. This one's a little bit more aggressive. It's a little bit more reactive, right? I can break down the zone that I believe price is going to reverse in using my Fibonacci numbers. Again, I would probably want to look for a deeper penetration than one that is shallow, right? If I don't get the trade, that's okay, because I still can wait for that confirmation at the higher time frame, and I would still have gotten back in on this trade. If I'm an aggressive trader, well, maybe I get into this trade as is, and then as I confirm at the higher time frame, it might give me an opportunity to add on and put another position on. So I could have two trades, this trade and this trade. Okay. So let me get rid of those so we can clean this up a little bit. All right, remember our Keltner bands? So one of the other things that we can do, and this is really what I like with Keltner bands, is that our mean reversion on the Bollinger Bands is that standard deviation, right? And Keltners are really based on average true range, and they're also exponential moving average. It means an exponential. So it's a little bit more sensitive to current price. So let's add those bands back. And again, what we'll notice here on this one is, right, there's our candle that is in that envelope. But notice that our mean is a little bit closer to our entry. The blue line here is the mean of the Keltner bands. So I like to use the Keltner mean as a target versus using the Bollinger Band mean as a target. Now, again, one of the things we can do is, as price is rewarding me, I can move my stop by the rules that I have chosen. I could continue to raise my stop as I'm getting closer and closer to my target. Now, another technique that we can use to help us find a more realistic price target would be, again, our Fibonacci's. What we're going to do here is we're going to look at the last leg that brought price from a reversal to our Bollinger Bands. So here is my highest point of this leg out down to my Bollinger Band. There's the lowest price of my candles. And I know it's getting a little messy here, but let me do this. Notice where our two bands cross, our mean bands, and it is also that 50% retracement. So this is another good technique to set a realistic goal. I probably want to be out of this Countertrend trade, or at least find some way to lock in profits or to move my stops when I get to that 50% retracement on whatever leg that created my opportunity. Now notice when we get to like 26 or 38, that might also be opportunities to move my stops higher, again, to lock in prices. And to be honest with you, on this trade, I probably would have rang the register when I got to that 50% retracement, but maybe I had multiple contracts on. Maybe I just took one off and still wanted to see if I could get my ultimate goal, which was our mean reversion, which was this line here, But at this point, what I can do is I'm moving my stop up, and to be honest with you, probably would have been stopped out on this trade, right? And this is important. This is an important fact of counter-trend trading. We need to be very, very disciplined because we never know when this trend is going to come back into play. So let me remove the Fibonacci's. Let me put back in the Bollinger Band. And you'll see what I'm saying. What's our trend? Our trend is down, right? And as soon as price reverted back to the mean, what did price do? It shot back away, right? Our primary trend was back in control, even though price did come back later, right? And then get to our mean reversion at the hourly time frame, the daily time frame. It still, once it touched that line, it bounced away. So that's why we need to be a lot more realistic. We use the Bollinger Band reversion to set the trade, to assess the trade. But when price returns to that mean, that's probably a time for us to get out of our contra-trend trade. Okay. So I see a couple questions here that Gene has put up for me. And let me see if I can answer some of these questions. So Jeff's left, but Jeff asked, how do you calculate risk reward? Again, it's just how much are you going to risk in the trade, your entry minus your stop, and how much is the potential reward from your entry to your target, and there is your ratio. So Ron asks, do we enter on the candle outside the Bollinger Band, or do we wait for the next candle to close inside the Bollinger Band? So Ron, great question. Two techniques. We can enter as price comes out of the Bollinger Bands if we have a zone, and I've done that risk assessment where I'm going to use the zone, again, down here, use that zone as a backstop, and I know how to assess my risk. Ideally, though, Bollinger Band retracements, mean reversions, work better when we get that confirmation. That confirmation when price returns inside of the band. That confirmation when we see price reversal, the candlestick pattern reversals, right? So it depends on the type of trader. If you are aggressive or if you are conservative. If you are more conservative, you're going to wait for the price to go outside the band and then wait for the pattern reversal and price to return inside of the band. I think Ron asked the same question there twice, all right? So Christopher asks, I noticed that interval is daily, and will smaller intervals support this methodology? Yes, Christopher. Price action patterns, candlestick patterns are fractal. In other words, they repeat in all time frames. And it's very cool that a lot of times what you'll see is on that candle that is at the daily level that is created outside of your Bollinger Band, if you broke down the shadow or the wick in a lower time frame, what you might discover is the same reversal pattern you see at the higher time frame being created inside of that wick or that shadow of that candle. So the patterns do repeat, and you can rely on the lower time frames. And what's nice about that is it allows you to take a deeper entry on a Bollinger Band piercing, but also a lot less risk. Great question. So David asks, why not just take profit when price returns to the mean? Yeah, that's fine, David. That is your prerogative as a trader, right? I set the risk. I'm going to set that risk. I'm going to set my mean reversion as my target. I'm either going to lose money or I'm going to make the mean. Yeah, that is fine. But the problem is that we're fighting trend. And what could happen is as price gets close to our mean, our trend could come back into play. So that's why we need to be a little bit more proactive on setting realistic targets, and why I showed you two different techniques to set a more realistic target. Good question, David. So AJ says this all sounds good with hindsight. Would this be a good trade to trade volatility markets when the VIX is say high due to Omicron? So I have talked about a lot of these in terms of futures markets, and you can use the same techniques that I just explained in equities markets. So AJ, maybe in equities markets, what we're at a disadvantage is that we don't get the leverage like we do in futures markets. For instance, if I get $1 move in a stock, I only make $1 per share. If I get $1 move in, let's say, crude oil, I'm going to make $1,000 for each one contract. So there's a lot more advantages in Countertrend trading if we're using futures contracts. But what markets, they'll give us a lot of leverage that are related to equities, and that would be options. So what you could do, AJ, is you discover the zones, you discover the price action, you discover the values, and then you trade the options against them. In other words, if I like the stock, maybe I sell the put as the market is falling. The volatility is increasing, right? People are buying puts. They're afraid the market is going to go down. I'll sell a put that's inside of my demand zone based on my Bollinger Band piercing. Or I buy, that out of the money call that is our mean reversion. The only problem with that is that, if this comes on, let's say, an earnings event or some kind of other volatile event, a lot of times after those events happen, you do get a volatility crush. So you might buy something or buy an option and you might get the right price movement, but you might not get the big reward that you were looking for because volatility falls and then that option doesn't appreciate. But good question there, AJ. All right. So I see one more question before we finish here. We're getting close to the top of the hour. So John asks, what combination of tools can be leveraged within the site? A lot of these Countertrend trading parameters are set that pulls up a position that is achieved in the right condition. So John, we do have some tools that are related to the equities, and that would be in when you look under an equity. Let me pull up an equity here. Let's, for instance, let's go back to Tesla. We have, let me see if I can find it. I'm looking for the, here, Barchart opinions. Yeah. So there are some other tools you can look at. And one of the ones that we do have is called strength and direction, which breaks down all these different moving average tools. And what you could look for is, think about, I want to find a strong trend, a lot of strength in the trend, but I want to see a quick directional change. So I might look for a current strength in trend in Tesla. Think about what Tesla has been doing, but maybe I want to look for a directional change where maybe my directional change is weakening. That would be a good opportunity to look for those Bollinger Band opportunities. Now, the problem with this is a lot of times by the time you get a weakening signal on your direction, price is already moved, right? But you can use this. Another technique would be look at, for instance, monthly highs or 52-week highs when your market is at those high levels. How far is it from, let's say, a 20-day moving average? So those are a couple of different techniques you could use, all right? Okay, I think we got most of the questions. All right. Anything else you want to add, Jean?
No, just that everybody will get a link to the recording later on this afternoon. If you are familiar with our website and our webinar archive page, that's where the recording will appear a little bit later on today.
Okay. So before we go, I want to give you guys a couple of takeaways, but I do see I have a little bit of time left. So I did have two more preset ones. I just want to see which one looks better right now. Give me a second here to look them both up. So one of the markets that's been in the news the last couple of days has been crude oil. And the reason why I wanted to show you the crude oil trade is really the caveat to this type of trade and why it's so risky, right? I mean, you couldn't ask for a more extreme price movement in crude oil. What did it fall? $10 in one day, right? And then did price go outside of zone? Yes. Did it create a whole candle? Yes. Did it fall in a potential area where we think maybe price is going to reverse? Yes. Why it's very important for us to use risk management, right? Because what happened? Price came back into our Bollinger Bands and went right back out, okay? Why stop discipline is really important in this one, because you could have really run over in this one if you were waiting for that mean reversion. Now, the trade looks like it's going to be a good trade when it finally does snap back, because our mean is so far away, but we still need use proper risk management on this one. So this could be an opportunity for us in the next couple of days. I'm thinking maybe we will look for something a little bit deeper in here, but let's look at this in terms of a lower time frame. And that line right there was the top of a zone that we were kind of looking at. Not a great Bollinger Band candle outside, but that is a candlestick formation that we can agree on. That is a reversal pattern. So that would have been an opportunity. Here would have been your entry, 65.47. Your stop would have been 64.11. Still, a lot of risk in this trade, and yet, you got a bit of a movement out of it, but you certainly didn't get your objective. So again, real important why we need to make sure we use proper risk management. Okay, one more, since I do have a few more minutes here. This is sugar, and why I like this one is we talk about trends in terms of uptrends and downtrends, but there's a third trend, and that one is a sideways trend or a range-bound market, and that's what we're seeing here. You can see that sugar was stuck in a range, and we did get a piercing outside of this range. Now, you're not going to get a great explosion in price, not extreme movement, but we did see price move outside of this range. Now, and normally what we would think is this would be a breakout, right? That price should continue to go higher. But price entered into an area where we believe that price is going to reverse. It came into that zone, and then it popped back out. And not only did it pop back out, but it fell back to the mean reversion, and then it went to the opposite side. This is called a failed breakout or a false breakout, or also sometimes referred to as a failed auction. Now, if I went to a lower time frame on this one, and there's my breakout, there's my structure, and again, not outside of my lower time frame Bollinger Bands, but it was outside of my higher time frame Bollinger Bands. There's our structure. On this trade, your risk was 2048 to 2061. Excuse me, 2063. About 61 it was. Yep, 1. There it is. That's 13, and our mean reversion was down here around 57. So 13 times 5 would give you around 65. So we'd be right there. That would have been a nice little trade. But also it was a failed auction. So once we got back to halfway into the zone, it went all the way to the opposite end. And this would have been a really nice contra-trend trade based on a sideways trend. All right. Okay, so let me end there and go back to my slides. So what are the takeaways? First, price recognition. Look for that price deviation far and fast from our mean, right? Using our Bollinger Bands, using our Keltner bands. Confirmation. Has price reached a level of support or resistance that I anticipate a price reversal? Inside of that area, do I see candlestick pattern reversals? Do I see price returning inside of my bands. Have my candles change color, that reversal? Is there a candlestick pattern that is a strong reversal pattern, ones that I believe in? And has price returned inside of that outer band? Again, price recognition, confirmation, reversal. Define your risk. Where am I wrong? Where is that trend going to be back in control? When we get above the candle that is outside of that range, when we get below the candle that is outside that range, I know I'm wrong. Get out. And choosing a realistic reward. Use that mean reversion. Is it large enough reward to justify that contra-trend risk? Again, a guideline that I gave, every trader is going to be different, 5-to-1. But I also show you techniques where I can learn how to mitigate my risk to increase my risk reward, but also be aware of when price returns back to my mean, I need to be proactive. I need to find ways either to take profits or to lock profits in. Okay, so I hope you guys enjoyed today's session, and I know Gene is going to ask me to do this. So next week, our upcoming webinar, you will see, we don't have one. So I'm off next week, but we'll be back in 2 weeks. In the last 2 weeks of the year, we're going to do, we're going to look at, go back into options. We're going to look at our long butterflies, and then we're going to finish the year out by looking at the dogs of the Dow, something that we did in the beginning of the year. We're going to go back and look at that. So those will be our two that'll finish out our year before we head into the holiday break. So until then, I want to wish everyone the best of health, stay safe out there, and the good of all trading.